Recording in progress. Good evening, everyone.
Yes, good evening, sir. How are you?
I'm good. Do we have any members from the group that is presenting today? If there is any member, you can share the screen.
Yes, sir. It is our group which is going to present.
Okay.
Yes.
So if the group is ready, you can share the screen while we wait for other people to join us.
Yes, sir.
Yeah.
Colleagues, are you seeing my screen? As today, this thing is misbehaving.
Yes, James, we are seeing your screen.
But I'm not seeing my on my side. I don't know what could have happened. I see I'm sharing, but I am not seeing on my side.
Even me, I'm not seeing it. There is something, but it's not what you're going to present. You
Yeah,
can
it's
first
not clear.
unshare, stop sharing, then you start again.
Mm.
Are you in? It comes and gets off from my side. Is it my?
Maybe another group member can share, then we will be explaining as he scrolls.
Can anyone help me? I send.
Yeah, you send, then let me try here to share.
Have you received it? Have you received it?
Let me check.
Yes, I've seen you have blue ticked it. But I don't know why. Why today? Yet I used to share. What could be the problem?
I'm trying to share it.
Okay, let me go off.
I'm trying to share it and I don't know what is the issue.
Stop here.
You are a bit moved to this one. Okay. This thing has refused with me, huh?
It has refused with you.
It has refused.
Whoa. Let me check this.
You first try to send to my emails if I can access it. I'll open from here.
I'm trying to share it and it is refusing. I don't know why.
You can help me with the email?
Is it okay now?
Yes.
Okay, maybe James, you can start from there.
Yes,
James
it is okay.
Yeah, you can start with.
You go to try to zoom it, I think, such that way I can see the words.
Okay. Is it okay like that?
No. Increase. They have gone to mute.
Is it okay?
Yeah. More.
Okay.
More. It was better before.
Like that?
Again. Yes, continue. One more like that. One more. Oh, yes. There is okay.
Okay.
Thank you. Sorry for the delay. Our apologies. Technology is so funny. Good evening, sir. Good evening, colleagues. My name is Aderu James. Going with you together with my team. We are 5 in the group, and all of them I see around. We are going to talk about what is called working capital, which is really common with us, and we need to know about this. Working capital management, this is a comprehensive guide to liquidity, efficiency, and financial health from foundation concept to advanced ratio analysis, designed for public finance students and a practitioner as a master's level students. So this is a business. This is something that one ought to know when someone is starting a business, what you are supposed to do, what you have to be in mind. So a working capital is normally the process of managing your business. It has what we call the current assets. Then we have inventory, accounts receivable, and current liability. These are all, we found it in accounts which are payable in short-term loans to ensure the organization can meet its short-term obligation, while in operating what? Efficiency. That is what we call capital management. So in capital management, all those aspects must be there to make it move in a smooth way. What does it mean? You can go to the next slide. The working capital measures farm.
James.
Yes, please.
Let me come in a bit in the introduction part of working capital management. Hello?
Yes, please.
Yes, there is something I want to add in.
Please.
It has been often observed that the shortage of working capital leads to failure of a business. The proper management of working capital may bring about the success of the business or a firm. The management of working capital includes the management of current assets and current liabilities. That is where you are right now.
Thank you.
I just wanted to supplement on the aspect of shortage of working capital. It can lead to business failure. A business can fail if it does not have working capital. Okay, thank you.
Thank you for supplementary. So when you look down there, you'll find that the formula of working capital is equal to current assets minus current liability. So all these aspects works together with the what? With the working capital. Down this side or the left side, it is whereby it says the current assets, and there is also what we call the current liability, relieved and inventory resources, accountable to cash and operating system. So when you fail to manage the resources, you will find that that's when a business will come down, whatever you are doing. So all those aspects contributes to the downfall if you fail to handle the what? The business in your organization, in the what? In the business. So you'll find that on the left-hand current liabilities, the accounts payable. These are taxes, wages, and short-term debits, and the obligations due to within 1 year. For example, you will find that maybe you will have a business which maybe you have borrowed money for 1 year and you wanted to uplift the business that you are having. So you need to be having something in place such that that money that you have borrowed from another entity, you need that money just to boost. And you have agreement say maybe for 1 year. So you need to pay that money within that year. That's why down here, like for example, for government, if you go for taxes, you fail to pay the taxes in time, it keeps on accruing or increasing. At the end of the year, the government will come for you. It depends how you have got. Even for the public servants, there is what we call the wages. These wages, at times when the government has failed to meet obligations or that organizations, where one is working and is supposed to do. There's what we call areas. The more it accumulates, it accrues and brings the organization to calm down. In short, it shortens the terms and it brings the debit to the organization. So we can move to the next one, what it means. Next slide. There's something I want to express there. I don't know how you can go it a bit such that the members will see what it means about obligation survival. You try to push a bit. Again, slightly. Why working capital management matters. Colleagues, try to zoom it again. Why it matters. One, maintains liquidity. It ensures the business has enough cash to pay salaries, suppliers, taxes, and other day-to-day expenses on time. So this is why working capital is why it matters in the organization, in the government, or in any business that you have. Two, we have what we call support smooth operations. Provide sufficient funds to purchase inventory and continue to produce the services delivered without interruptions. So you'll find that when you have the supportive smooth operations in your organization, those are the things which normally happens. You should be having the sufficient funds to run that organizations. You should be having what we call improved profitability, efficient management of cash inventory, and receivable which reduces unnecessary cost in the organization, and it has to increase on the other side the profit. Those are what we call improved profits. So if you have the effects management on the other side of cash flow, it has to increase the profit in your business or in the organization. Then you should be having what we call to prevent measures of preventing financial disgrace. If you lay those strategies, you find that it helps the business itself to avoid cash shortages and even late payment and excessive shortage terms from borrowing. The more you have, you'll find that you'll never go to borrow money because you have already managed from the previous what I've mentioned. Then you need, after that, you make sure that you have to be building the business credibility by paying suppliers, those people who give you, like you see, for us here in Kampala, people are moving with the trailers, they are moving with the box wagon to deliver some of the credits, some of the cash to your shop. So you should be having what we call building business credibility by paying your suppliers and creditors on time to avoid shortcoming. This means that you need to strengthen the relationship and improve the organization reputation to avoid and say that people to run away and say, when you give those people goods in credits, what does it mean? These people will fail you. Then you need to promote the growth adequate working capital. On the other side, allows the business to expand its operations and takes the other advantages to the new opportunities and respond to unexpected expenses. So all these things amount why you should be having capital management. Then I can maybe give you some kind of a scenario like where, let's use, for example, maybe a cooperative society that manages its cash well, can buy maybe granules, sunflower seeds during harvest. When time comes, the prices are low, he buys it. By the time the business is the farmers, from the farmers on that time, then he processes the seeds into cooking oil. I am taking now like mukwano, cooking oil, and sells the finished products without experiencing what the cash flow problem. This improved the efficiency of the what? It improves the efficiency of the what? Efficiency, and it brings what we call profitability, because after you have bought it before and now you are selling it after, meaning that grace period that you have given while you are handling it. So you'll find that by the time Mukwano is selling it to us, they have already gotten some loose profit, because they bought around January, whereby the farmers were harvesting, and now they are selling at this time. In other words, there is that picture on the on your right hand side. I was trying to explain this thing thoroughly using the pie chart, such that you can see what it means by capital management. But now, because of you cannot zoom it, I would even explain better, so that we can see how one can manage the business. You can even see on the yellow part and the orange part and the light red, there is a bigger part there showing the transaction in between. I am just trying to zoom it using my eyes because I went through. So you'll find that that part is the time whereby the organization was buying. And on the other side is the side whereby the organization is now selling. So this is why working capital management matters in any organization. So then you come what we call asset dominions. Current assets, I don't know whether you can zoom it a bit. They are faint on my side, but I talked earlier on about it. It is just about the majority, meaning that the majority of the total assets in many companies. The management directly impact overall financial performance. This is what already I was trying to explain of head, because these things were a little bit faint. So you'll find that the cooperator collapse. These are the risks. Failure to control working capital and manage the liquidity is the primary drive of the cooperator failure, or how the organization can fail wide. If you fail to manage that working capital, that is the end. So you need to be having a working capital. By the time you start, you make sure that you don't go into losses so early. Then again, you don't buy your resources assuming you have loaded a truck for starting. Then you keep on adding, you will not realize whether you have made a profit or you have not made a profit. And therefore, that's why you find some businesses think very fast. The manager has failed to know whether there is a growth or there is a decline in that organization. So you'll find that all these contribute to the management working relationship, working capital, and why it matters. With that, I will ask my colleague.
Yes, James, let me, before I go to the next slide, I can add like 2 or or three why working capital matter a lot to a business. Maybe if you can allow me to add two or one.
Please go ahead.
Yeah, one of the reasons why working capital matter a lot because it improves operation of efficiencies. Like for example, if the accounts are balanced between the payable and receivable, a business can keep on moving and the supply chain will not be disrupted. And this matter a lot in working capital, that receivable items are in and a payable are outgoing, so that a business cannot be disrupted at any time. It is also matter because it drives strategic growth, like optimizing liquidity in the organization and cash availability. This is one of the a vital reason why working capital is so important in a business. I will also talk of it prevent insolvency. Like for example, if there are no profit, a business can fail. A business must move because there is a profitability. But if you are doing a business that cannot generate a profit, at one point that business will collapse. These are the 2 or 3 points that I wanted to add. Thank you, my brother.
Thank you. Let me bring the thing before I hand over. Colleagues, I talked about current liabilities, and I needed to give you a highlight about current liabilities, and it is the example on top there. A current liability is a debitor or a financial obligation that a business is expected to pay. You must pay it. For example, I remember I mentioned it that when you are buying it, when you are making a credit on 1 year, you make sure that you pay. Meaning that if that business is expected to be paid within 1 year, 1 year or within it is normal operating, a cycle. Please, you need to do it such that it cannot bring you down. Example of the current liabilities: 1, accounts payable or creditors. For example, we say money owed to suppliers for goods or services bought on credit. So those are the examples of the what? The liability. Short-term loans. These loans that you see women pick from today, next week you get. Loans that must be repaid within a year. I go in the bank, I need money and return in a year. I go in any debitors who give money, the creditors who give money, those people who give the money, you make sure that you pay. Those are what we call the current liability. Then accrued expenses, meaning that expenses incurred but not yet paid, such as wages or utility bills. For example, umeme, water. They keep on, but the time will come, these people will cut water. Then the tax payable, taxes owed, I can say maybe to the government. Government has to pay. Those are tax liabilities. Then the worst of all is bank, what they call bank overdraft. Yes, these are short-term borrowing banks. When you go to those banks which give soft loans. Those are mostly examples that I think I can give you as an example of the current liabilities. Maybe I can add something below to some of what I have said. I like using a cooperative. You know, I am a man of cooperatives. If a cooperative society buys, a farmer buys a fertilizer on credit and agrees to pay the supplier within 60 days, the amount owed is which is owed is a current liability, because it is a must. You have to pay that money within 1 year for the supply, for the what? For the fertilizers for your farming in the village. So in other words, current liability are important because they are indicators. The business moves on. Then there is what we call short-term financials. These are obligations, and it helps. It helps the what? The assets. Whether the organization has enough current assets. So those are how you can really manage to evaluate it such that you will know it, such as maybe cash, inventory, and receivable what? To meet the obligations of the organization. So those are what I was trying to emphasize is for us to know what we call by the current liabilities, the examples of the what? The liabilities. Thank you so much. I would request one of my colleagues to continue with another slide, the next slide. Thank you. I know I will come back again. Thank you for listening. Any question, any supplementary from our viewers, from the lecturer, welcome. Thank you. You can, my colleague can take over the next slide.
James, I would want
Yes.
to supplement on what you've spoken.
Thank you.
The lecturer will advise us there. When I was carrying research, I found working capital management has two concepts. The first concept is the quantitative concept. According to the quantitative concept, this is the amount of working capital from the total of current assets.
Yes.
Then there is the qualitative concept, which gives an idea regarding source of financing capital. Quantitative concept is the amount of working capital from the excess of current assets over current liabilities. It's the excess of the current assets over the current liability. We didn't include it in the work, but when I was reading, I found working capital has two concepts, the quantitative and the qualitative concept. I think the lecturer will help us clarify about that.
Yeah. Thank you so much. He has brought it because when you go to slide 1, that's where I call current asset is equal to what is the other one over the other, and it was up there, but I think we did not say it, but I also saw it about qualitative and quantitative. It is really true. Both of them are there, but we did not capture. And also why we did not put it, we didn't want to congest our slides, and we wanted also to use our brain such that to put, but we have a data supporting all what is there in the slide. Thank you.
So I move on to the next slide now?
Yes, please. Try to zoom it. Try to zoom it.
Okay.
Yes. Yes, yes.
Is it okay?
Yes, yes.
Maybe you can try clicking on slideshow and you see how it's going to improve it.
Okay.
Slideshow should be down.
Just after animation, there is a slideshow up.
Yeah, I'm
on
seeing it.
the
Yeah.
toolbars. Yeah.
Is it improving?
You first
No.
click what is up here on the toolbar, up on that line of home, insert, draw, transition, animation, slideshow.
Yeah.
Up.
That one? This one? Like that?
Yeah. Then, something like that.
Okay. So I go to this one?
Yeah.
Yes.
Yeah, I think it is better like this.
Yes.
Oh, okay. Thank you. Maybe Jamie, Jamie? I think someone can come in after.
What are you saying?
Will you continue with this, or I come in, or someone from the group come in?
You can, if you can do it.
Okay.
I will give you a whatever, or I can handle it.
Okay, handle it. I will help you in the next slide.
Okay. In this diagram, it talks about the liquidity, profitability, and the trade-off. Only the words up there are not really clean. But what does it mean by the liquidity profitability trade-off? Let me explain, then I come to the diagram. It says that it means the liquidity, then trade, and profitability is a financial management concept that explains the balance a business must maintain between having enough cash to meet its short-term obligation and earning a higher returns. So by meeting enough cash to meet its short-term obligation, that is what we call liquidity on your left-hand side. Then by earning a higher, it returns the profitability. Now, when you come under liquidity, you'll find that I'm not seeing these words. So you'll find that this is how you are supposed to flow. From liquidity, those are the assets that you have been having, and it has been trying to multiply in the box, and it has to move gradually after moving around because you have been hustling. At the end of the day, you move to its ability of a business to pay its short term. From here, you move to the next term where there is a tick. That is now uplifting the draft to the higher liquidity. So then when you come here, this is the third part of it, whereby multiplication, suppliers. This is now how your business is moving. You have been struggling from 1, you went to 2, now you are multiplying your suppliers, your produce is now increasing, and you are now trying to catch up. Then you come to your product credibility. So you will find that by the time you reach to the last part on the right left-hand side, you are now accumulating your income because now you are gaining in your business. So by the time you are gaining, you will come now here. This is when you are multiplying. When you see that arrow, you are now climbing up on your ladder. And your business is growing. That's whereby you'll find that the manager of the organization will relax and see and say that at least I can manage to pay my my workers in time. When you see an organization paying people before the normal day, they have realized that the business has picked up. Now they have even seen the excess. And now they are working on a profit. That's why on left-hand side, because it says here, liquidity versus what? Profitability. So on the left-hand side, on your right-hand side here, now the manager will relax them more because he has already seen it. The profit is there. He can now buy without borrowing. What the profit can bring the goods, he can pay the workers, he can pay water, he can pay all the bills which are supposed to be done. He can even borrow his profit to government in case government wants some money. This is now where a business has really peaked on this side. That's why below there it is saying multiplication, multiple returns on the capital, where there's those three arrows, where the arrow is. This is now where you are really seeing it, how the business has boomed. And now the man is seeing is climbing. Now you can say down there, a percentage is winner one. But if he relax, and you see below there, then there now, the business will again come down if he has not managed up here, where the arrow. If you don't manage your profit here, it will decline again to come down because you have failed to manage your organization, or you have failed to pay people, or you are paying excess. So you will find that in the lower part, you will come down. So that's why you find the factory will either go up and it will come down. When you hear Kinyala or Kakira, they are closing, they will tell you that they are servicing the whatever, but they are not. It is the problem over here. So what they do, they close in order to gain the momentum from one side on the other side, such that they can generate what they come and sell at once in order to gain this profit back. I wanted to explain these words, but they are a little bit fake. Maybe I can talk about what they call the trade-off. Too much liquidity in trade-off up there, low risk, but low profit. Low risk, but low profit. Because ideal cash is what? I think cash is not being invested productively. So that is where now what we call the trade-off. What do? You need to put too much focus on it. Profitability goes into higher profit, but greater risk of cash shortages. And inability meets what is this? Shortage and inability. Also, it meets the shortage of the obligation in the what? In the organization. I like giving example, colleagues. A cooperative society keeps Uganda shillings. I can say, let's use 100 million in its bank. That is now a cooperative. Accounts to ensure it can always pay the surplus. So at the end of the day, this provides the high liquidity. But on the other hand, if it is much of the money remains, if much money remains unused, it earns little income, which is very true. When you don't buy those things, you'll never get more income. If the society instead use part of the money to buy, let's use still the sunflower seeds for processing and sell, it may increase the profit, but will have lost cash availability. For the what? For its emergencies. Because there are also emergencies, fire can come in. Workers may strike. What do I mean? Because you are not been utilizing the money and the money was in the excess. So at the end of the day, You are not paying workers and they have strikes. That is already now an emergency. You have not been paying the taxes, and the government is now threatening to close you, but you have been having money and you have accrued some of the areas you are supposed to pay. It brings that. So what do I mean by trade? So you mean that effective working capital management, it aims to achieve what we call the optimal. What do I mean? Optimal balances. That is the optimal balances between liquidity and profitability. These are what do I mean? It ensures that the business can meet its financial what? Obligation, while maximizing the returns. So colleagues, that is how these liquidity and profitability. You make sure that the organization has to manage how to do its financial, to do its obligation and maximize its returns into the what? Into the organization, or any bank or any shop, in order for you to manage and acquire your profitability to move in a profitable what? Way of getting your profit. Thank you so much. I beg to submit. Let now the colleague add, or whoever has not understood, they can ask and the lecturer can guide. Thank you so much. Or any of my colleagues can give him some supplementary, can add some what have not brought it clearly. Thank you. Yes, you can go to the next slide. Yes, one can continue with the with that slide. Yes. Okay. Let me say, we go to what we call liquidity ratio. What do I mean by liquidity ratio? A liquidity ratio is a financial ratio that measures a company's ability to pay its short-term debits and what we call current liabilities. The one we have been talking, using it is the current assets. So that is what we call here current ratio, current assets plus current liabilities. A ratio below may signal or distress, but context matters. Manufacturing firms typically maintain a ratio of 2.0 or higher due to inventory and receivable investment. The retailers like Walmart often operate below 1.2, negotiating long surplus credit while collecting from customers almost immediately. So I will explain on the left-hand side about that diagram. Then there is what we call quick ratio. Quick ratio means that current assets, inventory plus current liability. Exclude inventory, especially relevant when stocking. It is slow moving. A quicker ratio below is that 0.5 warrant a serious concern. So let me try to explain there such that we move slowly. The main liquidity ratio, I can use some example. Let's use the current ratio. How to determine it? We use the formula we use, which is current ratio is equal to the current assets divided by the current liability. In order for you to get all that. So I was trying to explain to colleagues here, maybe I can say a ratio of 2 to 1 is often considered healthy, although sometimes we can say that the ideal ratio depends on the industry. So these things normally works pose liabilities in the industries whereby so many activities. How many times will you come up with what you want? So there is also 2.0 or higher. Have you gone higher or have you gone less? How many bags of sugar will one produce at the end of the day? What happens such that yesterday you produced 150 bags and today you have produced less? Then there's what we have cash. So cash, there is a cash ratio. It is a formula I can try to get. I read it. It says in what's this? Cash ratio, which is equal to cash. Let me try to guess. It is cash plus cash equivalence over current liability. What you have got, what you had before, you add with what you have got as a equivalent over the current liability, the bags. How do I explain one to understand well? You had something and you have gotten something. But before you had something, in order for you to get all that, you need to get to say that maybe current asset is equal to, let's use it some figures in Uganda currency, 80,000 million. Then the current liability, I can guess and say that Uganda shillings is 40 million. Then what is next? The current ratio, I can put it in this way in a local mathematics. 80 divided by 40. Whoever has a calculator, it may give you maybe something, 80 divided by 80, 2.1 ratio. This means that I can even say that now if you get 2 that, meaning that my cooperative has grown. Because I have 2, we round it, you can just leave that one and say Uganda shillings. Because 80 divided by 40, you could be using a paper, colleagues. 80 divided by 40, you will get 2.1. That is the ratio. I guess it, I believe it. You can check it. Meaning that the cooperative has gotten 2 of current assets for every one of its current what? Liability. Lecturer will help me in that maths and he will guide, indicating that a good ability, it means that the ability has met its short-term obligation in that organization, quote Kakira. That's why on the right-hand side, the turnover is there. So you'll find that when we start from below, this is how the liability was. You at the first, it was really something surplus, small. And you continue, as you continue, it becomes something which was growing. At the end of the day, it goes to the constant. That will be at 2 point years. I was talking, I was not even bothered about here. So when you look at it here, it matches with what I was trying to tell you, that the ratio will go to 2 to 4. The ratio will be 2 at 2.1. Then there's what we call quick ratio. This is the current asset, inventory, plus the current liability. Excluding inventory, especially relevant when stocking is slow. Moving, You see, when your stocking is moving slow, so you find that there is a way how business will not move. You never get a profit. You have bought a bag of posho which he has taken 4 months without you selling. And the other one has bought a bag of rice and he has sold in 3 weeks. So you find the US will be stagnant and the other one is growing. So you'll find that a quick ratio below will become too low. It will go to 0.5 warranty seriously. You get it? While in the industry, context is essential, meaning a healthier ratio is a sector sufficient, not a universal. So that is how the ratio, liquidity ratio is handled. Thank you so much. You can move to the next slide. My colleagues can handle any? Can someone handle efficiency? Efficiency ratio. Right. Let's see, in efficiency ratio, inventory days, inventory plus cost of sales. This is now, it talks about now in a degree, I can call it, what is this, in 360 days in a year. So estimate time to sell inventory, low is generally better. But compare against industry norms. In example, a year ends.
Maybe
I
think James, let me help you from there. You know, my internet was on and off. I did not hear you. I can help you from there.
Thank you. Now can take over.
Yeah, and you take some water. My internet was on and off. I didn't hear you very well.
All right, thank you.
Yeah, here members, we are talking about efficient ratio. Is one of the ratio that is used in a business, and sometimes it is also known as activity or turnover ratio. And beside it, we have different type of efficient ratio, of which my colleague have talked about them here, and we are seeing. So let just tackle them one by one, and let's go through one by one. We are talking here about inventory. About inventory is sometimes called inventory ratio, and this is inventory days. So it is calculated in inventory divided by cost of sale times 360 days in a year. This inventory estimate time to sell inventory lower as it is generated. So it is compared against the norm, and sometimes it is measured in a yearly inventory. So that is about inventory. We also have a payable days, which is payable divided by credit purchase times a number of 365 days in a year. This one also tackle how long the farm takes to pay a supplier. For example, extending a payables, it may affect the liquidity and risk loss a lot of money to the organization. So this is one of the ratio that is used in efficiencies. We also have a receivable days, which is calculated in a receivable divided by credit sale times a number of days of 365 in a year. And it is measured mostly as how quickly a customer can pay and generate money on sale. So this is more of a cash flow, and sometimes it look at the credit that are used. We also have sale to working capital, which is sale, open the bracket, inventory plus receivable minus the payable. So sale to working capital is a ratio that is calculated, and it shows the efficiency of the working capital, the liquidity that is calculated in sale. So that is one of the that is one of the ratio that is used. We also have one that has not been covered there. We have also account receivable, which is turnover, and it is in inventory. So unless there is a question, this is what I can say here about in efficiency ratio. Can I move to the next slide?
A minute, let me add something there to our colleagues and the lecturer. There's what we call asset turnover, which is equal to the sale over total assets. So that one is also there. That is the formula. But now I want to give some light as I conclude on that. Why efficiency ratio matters. Why does it really matter in an organization? They show how well a business uses its resources. The other thing is it helps to identify the waste or ideal assets. Whatever you are doing, you will know that this one is wasted, the other one is being proven. Then it improves in the decision making in working capital management. Because now you are seeing it, you will decide what to be done. Then it increases the on the other side the profitability when resources are used efficiently. Me, I am a man of cooperative. I like quoting this one as a last example. In a cooperative sells sunflower oily quickly and collects money from a customer, a gross sunflower on time. It has a higher efficiency, meaning its assets are working well to generate what? Income. Because when I buy my whatever from my clients, I get the sunflower oil quickly. And I also collect my money from the customers on time. In short, I can say efficiency ratio measures how a productivity a business uses its asset to generate the what? To generate the sales and profit. Thank you. That is how it can move in any organization. You can move to another slide.
Yes, this is the culture operating cycle. It starts from inventory days, payable days, and then receivable days. We have interpreting ratios, which look at the raw ratios and meaningless without a context. Maybe James, you can explain this. I'm not so familiar with it.
Okay, it is what is this? This is let me say, let me explain to you a bit about it. A ratio framework in maybe in a financial management. It is a way of organizing financial ratios into a clear group so that you can easily analyze a business. You can analyze a business performances from a different angle. That is it. Then I can say maybe in a wide use of a framework, we can extremely talk about one, external benchmarking. You compare against the industry, you get the average profitability and the business. For example, schools or communication, however, you'll get it like in treatment, in the benchmarking with the certain what? Countries. For example, you find that the poor management may produce errors in the what? In the industry. This is where most of the things measures their ability to apply a short-term debitors. It causes by the current rate ratio caused by quick ratio and by cash ratio. So you will find that all these things normally are contributed to interpreting the ratios, how it the framework, how it works. So you'll find that you weigh it from the trade analysis in order you to benchmark the external effect of the organization. Then aspiration targets. These are benchmark long-term performance against the sector leader. You find that if aspiration you have not really planned well, it will not really work. And this is done by whereby Uganda will go to Kenya, Kericho, to learn about how fish farming is handled. So aspiration targets, one has to go and benchmark in order to come up with something good to lift the industry. So you'll find that the industry norm may represent mandatory and excel, it can excel out of it. So now you will find that out of that, that's where you will get what we call profitable ratio, whereby earning ability will be there. And those are the things I can say, measuring how well the business generates the profit. I mean the profits. 1, by gross profit margin. 2, net profit margin and return on assets. Then the other one is return on equity. So now when I can say, I can even ask you that, how do you know that the whatever is, the business is making enough profit? Then there you say leverage, gearing the ratio. This is where now the debit level will come to ensure the level of borrowing and the financial risk can be really low by debit to equity ratio and by debit to ratio, and interest coverage has to come. This is where interpreting ratio and the framework will come. Over that, it will even come what we call market value ratio. Investors appear here. What do I mean here by the market value ratio? This is whereby I merely use, I think, the companies listed on the stock market, earning per share. You hear when you go in the bank and they say, how many shares do you have? Like now, for example, I use myself, I have a cooperative. To become a member, you should be having, at least you should have bought a share. And they track that share. For example, I can say to buy one share is around 400,000 times now the number of shares that you get in order for you to earn what we call a dividend. Because the more you save, the more you get, the more dividend. So the earning per share, then the price to earning, those are the ratios all. I thought all those things are called ratios. Then the dividend yielding. So you'll find that the more you save, the more you get more money at the end of the year. There is what we call of my head. This is what we call sample way of remember. I mean, what do I mean? The simple ways to remember the what? The framework. We can use what we call liquidity, efficiency, profitability, leverage, and markets. All these things comes under the framework of what? Of inspiration ratio. As I conclude, I can guess off here by why this framework is useful. 1, it gives a complete financial picture. Colleagues, I am doing this thing I'm presenting on the view because I am a cooperative. So it gives a complete financial picture because of this recap of the financial framework. Then it helps to compare business failure This framework helps you to know how you are failing. Also, if you get the marketer, the person who does M&E, it will help you to tell you that when we do like this, we are failing to fail. It supports better financial decisions. When you sit in your committee meetings, you are supporting the better financial decisions, because now you'll be knowing whether you are going to get a good dividend at the end of the year or you are not going to get it. So all these things commonly used in the financial analysis, audit, and project proposals. Why am I bringing those things? I bring it because when I was concluding the last year, I had to call the auditor to come and tell me the progress. Am I growing? The auditors came and told me I am on the right track. So that is what we mean interpreting ratio and a framework. In any organization, they must be there. And on the left-hand side, when you look at the pictures, they are trying to analyze about the framework for the growth of the what? Of an business. So thank you so much. We can move to, I think, almost the last slide. Can any person go through about the case study? The case study of the case study. Yes. Now, the case study, I can say it is general. This is whereby you have to come with something general about what you have been doing. What is that you have been really projecting? It is the case that you are presenting.
James.
Yes, please.
Can you take a rest? Let me do some supplement of what you were trying to take us through about how to interpret ratio. Just a little bit there as you take rest.
Thank you so much.
Good evening, colleagues. Good evening, our facilitator.
Good evening, Andre.
I'm okay. I just would like to do some bit of supplement about what our colleague James took us through. When we look at how to interpret ratio, here as a company, we need to look at the trends over time to see if things are improving in the company or things are worsening up in the company. And then also, we try as a company to compare with the industry averages of what is normal for that particular sector. Then at the same time, as a company, we have to aim higher than the average by comparing with the industry leaders to see what really excellent looks like as a company. Are we together?
Yes.
Yes. So that's something that I would like to add. Then coming to the case study that James had wanted to start presenting, here I would like to also hint something a little bit. Looking at this company has was working capital matrix than the typical companies. It also takes longer to sell the inventory and get paid by the customers. Looking at these case studies. And at the same time, it pays its supplier faster than what others do, which also hurts the flow of cash. When looking at this case study, you also have you look at the small cohesion of cash, highlighting they might need better credit control and at the same time long-term loan instead of the short-term borrowings. Okay. So James.
Yes.
That's what I would like to help with.
Thank you so much. Exactly, that is it. So maybe I can add little on that. About it, we can go through what they call current assets. This is now the chart how the metric. The metric how now the progress of the industry is. You find innovatory days at 60. Then the industry's average at 3. You find that there are receivable days, then there are pay days, then there is cash opportunity circles, and the rest. So I can try to simplify by saying it that in order you to get those things, you will find that you are given around the current assets, maybe 150 million shillings. Then the current liability, for example, that's what is explained here, 60 and 33. You'll find that you're given 100 millions. Then the cost of goods sold is equal to that, to 200 and what? And 40 millions. So the end part is average. Now, when you look at it, the average of that, average inventory is 60 million. Then the sales are 40 million. And the profit you may get at 40 million. The total debit you have to include there as a, for example, I'm giving examples like 120 million. Then equity has also to be there as 180 million. So all these things contribute for the growth of the what? Of your case study. Thank you, and we can move to the next slide. So the key task. Can someone take us to the key colleagues? My.
Yes.
You can take over. I can add for you.
Okay. Looking at the key takeaways from the lessons, we are seeing here cash flow matters most. Even profitable companies. These profitable companies can fail once they run out of cash. Okay? Then everything is connected. When you give customers credit, this at the same time can boost sales. But also, it ties up money that is required to run the day-to-day business of the company. The cash cycles tells you where your money is stuck. As a company, you need to try and shorten this up. Compare your company ratio with the industry standards, with the trends, and with the top performers. That's what I can add. James, maybe you can conclude.
Thank you so much, colleagues. Liquidity is non-negotiable. Here, profitability means nothing without a cash. It meets obligation. Monitor current and equity ratio. So without those things, you cannot move. Every competence interact. Exciting customer, carry my boots. So in all the whole thing, what I can say is that the key takeaway from all this, liquidity is moderate. When we go back up there, we're looking at the ratios, it can be 1.5 current ratios, meaning that the company can pay short-term debits, but it does not have a strong one, safety way of managing the what? The emergencies. Efficiency is the average. That is innovatory turnover. We saw it, which is equal to 4. Innovatory, meaning that out of it, it moves slowly, meaning cash is tied up somewhere. So when you don't make the flow of it, your cash is being tagged somewhere. Who is tying the capital? You have given James the money, 1 million. You are supposed to buy produce next month, next week. James has failed to give you 1 million in time. He has tied all what you are supposed to add to bring what you are supposed to bring. So the whole business will remain what? Will remain really stuck. Then the profitability is low to moderate, meaning 10%. The next profit will be a margin. The business is making profit, but it is not maximizing the earning from the sales. You make a business, the profit is making, but we are still on the same level. You cannot really see it very well. You can't add, you can't come, but you are there for 3-4 months. It is really stuck. So you'll find that you cannot minimize. So that is what then the leverage is controlled by debit to equity, which is equal to 0.64, I can say. Because equity has to be there, meaning the company is not over borrowing. You see, when you don't borrow, meaning you are steady, meaning the management financially is okay. Because if you are managing a business and you are not borrowing, going to the money lenders, you are financially managing business. You have what we call discipline, financial discipline. Then there's what we call what is this? Overall performance is stable, but optimal. Meaning now the business is operating safely, but it has room for improvement if the efficiency and profitability is what? Improved. So you are moving in safely, but the business is still a little bit staggering because the profit is not settled. That's why you find some people, today when you go, things are empty. Another day, 3 weeks again, he has brought it back. So you are just there, the business is not moving. At times you close. Then the main problem identified is that you will find that if you don't really see the movement of that business well, in order to give you the what we call maybe a relative low profit, to imagine an efficiency of the overflow for the overall performance of your business, it will really bring you down. Because that is the work of the management, to see that whatever you have manufactured, whatever you are selling should really relate to bring in income and profit. to you in order for you to pay all the workers, in order you to meet the obligation of the institution or obligation of what you have started with for that business. Because the business is for itself, for you to get all that. I think with that, I beg to submit, and I may think that the colleagues will come up with their questions. The lecturer will come over and guide and support us in one way or the other. Thank you so much.
Thank you, James and team, for the presentation. Maybe before I come in, other members can give their views on what has been presented. You can go ahead. Your hand is up.
Thank you. Good evening, colleagues. I do appreciate the presentation done by the group, and just wanted to have some few comments about the presentation. We know by the definition of working capital, it is all the process of managing a company's current assets and current liabilities to ensure it has enough funds to meet its short-term obligation while maximizing profitability. So there are two big items here in terms of when we look at the definition. So the whole idea is liability and the assets, and also making sure that there is available fund in case there is an obligation that will fall due. So the entire thing here is looking at now the current issues, like things that within one financial period of year, within that period of time, how is the company, how is the firm able to at least have available cash, not too much, not also small, but something that they can use at any time to pay for any liabilities that will fall due in the process. And of course, the objectives of this working capital is to maintain adequate liquidity, ensure smooth day-to-day operations, minimize the cost of funds, maximize profitability, and improve operational efficiency. Now, there are four major components when I was doing my own research about working capital. And the four major components include: one, the cash management. Here, I think it is talking about maintaining sufficient cash for daily operations. Then the second one is inventory management. Keeping optimal inventory levels to avoid shortages or excess stock. Here you need to be also a bit careful of the stock that you need to have available. You can have a stock based on the demand, but at times because of the period changes and the demand of some stock changes within a specific period of time. So, like for example, now in some of the region in Uganda, it is heavily raining. So people are so much into agriculture. So that means the stock that you need to have much for now should be more of agricultural things because people are into it. Then the issues of maybe like at the moment, people also look at managing schools items because children at school, transportation aspects because there are a lot of people who are moving day in and day out. So the stock that you have should always be looking at the current demand and how that available stock can at least satisfy the demand of the people so that you don't have serious shortage. Also, you need not to have a lot of stock because it will attract a lot of cost in keeping these items. And also, since you have a lot of stock, it will also hold the cash in that stock because the level of exchange of that stock into liquid also takes time. Then the third major component is receivables management. That is collecting payments from customers promptly. Once you make your sales, maybe you do on credit. So you need to look at your credit policy. And once the credit policy gives, of course, a lengthy period of time, you'll find that it is very difficult for you to have cash at hand when there is a need to pay for something because the customers have not yet reached the point of paying back the money that they owe. Then the fourth component is about payables management, making payments to suppliers on time without affecting business relationship. This is where you will buy also items from a supplier on credit. Now you to be able to pay the suppliers, you need also to look at your liquidity level so that you're able to aggregate the time period that you're able to pay, ensuring that what you have here can still run any other operational need. So those four components are very key in capital management. Then there is something that I also wanted to talk about, the determinants of working capital requirements of a firm. What are those things that can determine this is the required assets that are needed? This is now looking at this liability because working capital is all about asset and liability. So one is the nature of the firm. A trading firm will usually require more working capital than a firm in the service industry. So if you are doing a company dealing with the trading, this requires a lot. But if you are maybe doing with the service provision, like you are doing consultancy, of course, this one doesn't need a lot of working capital. Then also the size of the firm. A larger firm needs more working capital than a smaller firm that will need a smaller working capital. Then the business fluctuation. During time of high demand, a firm needs higher level of working capital as compared to periods of low demand. So we all know that during Christmas, of course, many people wanted to put on new clothes. So the demand for buying clothes is very high. So at that time, as a firm, you need to have enough cash in order to buy clothes so that you can sell because the demand is too high. And that's where you get a lot of money also. But now during this time, there is not much demand for clothes. People are now focusing into children's school fees, they're focusing into agriculture, they're focusing on other things. So there you balance out. Then the growth stage of the farm. A mature farm requires less working capital than a farm in the infant stage. When you are just starting a business, it requires a lot. But now when a business has started and has grown to a certain level of maturity, here there is no much need for working capital, but now it is you to strategize your business in order not to come lower, but instead to go higher. And that is the dangerous period of a business when looking at the business cycle. Then the availability of credit from suppliers. This also affects the account payable. And lastly, the credit policy of the firm. Once, as I explained before, when the credit policy of your firm, your own firm, has given ample time, of course, collection of this receivable takes time. So you need also to look at which is the feasible credit policy that you can use when doing credit sales. I think this is where I wanted to add. Thank you. If there are some additional, somebody can add.
Thank you so much.
Okay, is there any other person who wants to add? So even our time is now up, but I want to thank this group for the presentation. This was a really research presentation, and most importantly, all group members at least research and they are able to contribute. So apart from this group, all these other teams that presented, they left the presentation in the hands of only a few people. But at least for this group, almost all group members were able to say something, which is what we want. What you have discussed is true about our working capital. Our working capital generally is about management of current assets and current liabilities. So you have already handled that. You have told us the importance of working capital management, about that brings maybe sustainability of the business, having money to run the business, returns or profitability, all that you told us, and that is true. You also move deep into ratio, although ratio analysis is a topic of its own, but what you did also cuts across ratio analysis, because working capital is about managing the performance, having efficiently manage the business. But those ratios that you are showing us, it's also used to measure the performance of the business. Those are financial performance indicators. You can use ratio analysis to measure the financial performance, which is okay. So when we break current assets, we can have the most common one, we can have stock or inventory, can have cash or and cash equivalent. Cash equivalent, we're referring to those short-term assets that we can easily convert it into cash. We call them cash equivalent. Then we talk about receivables. And when we look at liabilities, we also talk about our payables. So you have discussed them. And as part of working capital management, you need to see how each of those elements under current assets, they are managed. For example, when we look at inventory, how do you manage inventory for the success of the company? You need to look at things like just-in-time purchase, where you only buy stock when you need it, such that you don't have your stock kept up for a long period of time. You have slow-moving stock. For example, when you use a liquidity ratio, under liquidity ratio, you talk about current ratio, which is current asset over current liability. So you need to have more assets than liability, such that you are able to maintain. A ratio of 2 to 1 is considered adequate for you to remain in business. Now, when you look at quick ratio, it is current asset minus inventory over current liability. You want to have more cash that you can easily convert to we want to have asset that you can easily convert into cash. So at that point, quick ratio, the ratio of 1 to 1 is considered appropriate. If you have current quick ratio of 1 to 1, assets of 1, then liability of 1, it means you can easily clear that. So one of the ways of managing these inventories is to use a just-in-time purchase. You only buy when you need, or you buy what you need, and you keep a low stock. You don't need a lot of stock, or you cannot keep much, which is tight, because if your stock is tied up, it means your capital is also tied up there. Then still under inventory management, could have also talked about economic order quantity. That is finding the cheapest order size. Here you want to maintain the ordering cost and then the holding cost. How much are you spending on ordering and how much are you going to spend on holding in terms of warehousing and all that? So that's how you can manage your stock. Then also you need to look at the methods of issuing these stocks. Like you can use FIFO, that is first in, first out. Whatever was brought earlier should be issued out first, and whatever came in last should also be issued last. So, and this stock method is recommended by accounting standard. If you look at IAS, International Accounting Standard 2 for inventory, it will recommend this FIFO. So as a way of managing your stock, you need to have that. Then when it comes to receivable or debtors, you talk about the inventory. You talk about the payables days. Receivable days. How long do you allow your debtors to pay? So you need to set clear terms for them to pay. Maybe set percentage and you give them. And also before you give those goods on credit to your customer, you need to check their credit background, credit history. Do they pay? Do they have the money to pay? Do they have any long-term, maybe default with other companies? So for you to manage your pay receivables, you need to, the receivable people who have taken goods from you, they need to pay within a short period of time, such that you have money to run the affairs of the business. Then other cases, if you have debtors you cannot manage, you can factor them out. You can hire another company to handle your debtors. Suppose you have a debtors or receivable to the tune of 1 billion, and these are customers. You cannot collect money from them as a company. You can hire to another company or another auction, possibly another company that is able to pay, to follow up on their payment. Maybe you can agree out of 1 billion, they can take 20% of it or 3% of the collection, depending on what you have done. So that is part of working capital management. Then when you look at payables, these are people you have got goods from them on credit. They are demanding you. How do you manage them? You need to negotiate lower terms with them. They should give you more terms so that you are not on pressure. People you have got money from, like the bank, they should give you on a better credit terms that you are able to pay. That does not put you on pressure. So that is how you can manage them. Then when it comes to cash, how do you manage that? The cash, you need to have the cash budgeting. You need to forecast what is coming in, what is coming in, and what is going out of the business. So that is cash management techniques. Then you need to set strategies to speed up the inflow of cash. How do you handle daily banks? Can you use mobile money maybe like that? You can also use other strategies. For example, like salaries. People pay salary at the end of the day. Other people, they also have liabilities that are due. Somebody talked about it. Things that you have already incurred, but they are demanding you have not yet paid. Thing to do is maybe electricity and other outstanding obligations. You see how to handle them, but within time, such that your suppliers, they are not nervous about what you are going to, they are not nervous that you are not going to pay. In case of even overdraft, you have gotten money beyond what is on your account. This is common with other people, with people who are running private schools. At the end of during holidays, because they expect students to pay money, they go and get money in advance from the banks. Then this money, they will keep paying back. So you can use some of these strategies to cover the gap such that you are able to control some of these things. So those are the working capital management techniques. Then those ratios that you have used, they are also used to measure performance, but you cannot use them in isolation. You need to compare with the industry average, like your last example when you were comparing one company with the industry average. So you look at it's a way of assessing your performance. So if the industry average says your payables days is, the industry average is 50 and yours is 30, it means the suppliers are putting pressure on you. And this pressure can affect your performance because you can even run out of money, or you will go to get more money to pay the debts. Things to do with over trading, where you want to do rapid growth, but you are not getting, you are spending more money. You can be having a negative cash flow trend where you are spending more money than receiving. So it can affect your business. So those are some of the things that you have covered. And when you came to the interpreting ratio framework, you talk about trend analysis. Trend analysis, here you can be tracking your company's performance, maybe for a period of 5 years or 3 years. And then based on the analysis, you can be able to predict what is going to happen. And like this ratio analysis, you cannot handle alone. You need to either compare with the past performance. For example, you can compare 2 years back or 1 year back. If you are looking at performance of 2026, you have to compare it with the performance of 2025. Then the external benchmarking is where you can benchmark with what is in the industry average according to that industry. You also show a graph where it was indicating different industry average. For example, manufacturing companies, if you are in that company, you need to compare with the industry average for modern manufacturing company or traditional manufacturing company. You can also be comparing with the retail company or supermarkets. As long as the industry average is there, you can compare with those performance depending on the industry or the kind of business that you are operating. Then you can also look when under aspirations, you can compare with a similar industry, similar company. For example, Airtel can compare its performance, compare its ratio with MTN Uganda because they are in the same industry. And then they see how they can handle their performance. So those are some of the things they use those ratios for. But again, those ratios, they are financial performance indicators. They have limitations. If the financial statements are not clear, or they are not correct, or they are manipulated, then it will give a wrong information. For you to assess the performance of a company, you also need to look at other non-financial performance indicators for you to assess the performance, the general performance of the company. Much as you can use, maybe you're talking about efficiency ratio, where you're maintaining how efficiently the company is running, but that one alone is not enough to assess the performance of a company. You need to look at other performance indicators. Example, look at the level of research and development in that company, or research and innovation. What is the company doing in terms of creativity or research? Customers' satisfaction. What are they trying to see that their customers are satisfied such that they don't move to other people? Then look at employees' motivation. How are employees motivated? Are they working in a good working environment? Are they paid good salary? Are they being given training, maybe capacity building? You look at that and other non-financial performance indicators to assess the performance of the company. Then also, lastly, this presentation, when you research and you present to us, you should also indicate us the references. Where can we get this information if we want to dig deep? So those one who are going to write a fair copy or a write-up on the presentation, you should also indicate the references. Where did you get this information from? We need to know. We can. So those are my comments. Otherwise, all these aspects were covered. And the last part I wanted to talk about was already discussed by Mr. Igu, where he talked about factors influencing working capital management. So you need to include that in your write-up. Then also at master's level, you are going to be managers. You should also take interest to do some bit of research on international working capital management. If you are working for a multinational companies, how do they manage their capital, working capital? Because at international level or multinational company level, you can be having a parent company that with its subsidiaries in different countries. How do you handle if you are made the manager or a finance manager of that company. So you can do a bit of research on international working capital management, and then you include in the write-up as you present. As you make the write-up, you may not present it, but you can include it in the write-up such that our members can read and then do more research on it. Otherwise, thank you very much for the presentation. If there is no any other discussion, we're going to stop here until next Friday.
Thank you so much.
Thank you so much, Prof. My question was on, we don't have a test because tests have started, and I think even the timetable for tests is out. When are we having the test for this specific course unit?
Okay, what we are presenting can also lead us to a marks, because this is already a presentation, which I'm going to give marks for each group that has presented. So that is, we already have a marks for that. Then you can decide if you need a test. I'll give you a test maybe next weekend. But if you don't need a test, we can still do another coursework, individual coursework, then you submit. Maybe those one who have missed the presentation, but of course presentation, everybody is there. Those one who will miss the individual assignment, they now can do the test, so that we have, but we need a minimum of 2, either coursework and test, or actually this presentation is like a group coursework, because I gave you the topic, you research on it, and you present it. That is a group coursework. So you can have an individual assignment where you can give a question and you go and research on individual basis and you present. Then we can also have an option of having a test. So it's just a matter of updating the e-learning with the marks for the presentations for everybody. And then we wait for when people are doing round 2 of the test. That's when we can also decide whether to have a test or to have an individual assignment. So is that okay?
Thank you so much. It is okay, sir.
It's okay. This is your second time of telling us that. I remember the other time you gave us that kind of suggestion before. But thank you so much. It's okay.
Yeah. So we're going to honor that. You already have a marks for test 1 in terms of this group assignment that you have given. So we're just waiting for the other one, then we shall be good to go. Okay, we can stop here. Thank you, and have a nice weekend.
Just a quick one.
Have a nice weekend.
Please. Excuse me, sir.
Yes.
Yeah, now in terms of this presentation that we are doing, because we know sometimes our presentation is limited and the coverage of the content of each of these topics that we're handling are not really into detail. Will there be time before we sit for exam that you will at least make a general recap of all the topics so that we get into some of the details in each of the topics?
Okay, what I see, what you present, they cover almost 80% of what is entailed in the topics. That's why if you are making a write-up, which you will share with other members, the comments that I always give, you should include it, and then you bring it all together. So it will be almost 100% of what is covered. So there is no need for me again to pass through each of them. So what you need when we tell you to add, you need to add, and you need to share the write-up with people early. Like those one who have already presented, they should come up with their write-up, they share with the members for revision purposes. Because I have to give you what is covered. If I'm to set exam, I will set it from what is covered. If I set what is not covered, how will you answer it? So that's why if they are presenting, you should also be taking notes of something. But if you cannot take notes, this presentation, we expect a write-up with group members and then shared with me, because I will base it to give you marks. If they ask me, what did you use to give these people marks? I will say that based on this presentation, this group presentation. So each group should come up with a fair copy or a write-up of what they presented. A detailed notes, even if it is going to be in a PowerPoint, it should be organized incorporating all the comments that were made, such that it is a complete note that can be used for revision. Even me, I will read through those notes and then set exam from those notes. I will not read anywhere. I cannot bring anything from anywhere which is not covered, because I believe what is covered is the right thing. If this is not right, I will tell you to go and improve on it, or I'll tell you that it was not covered. So that is how we're going to handle it. Those one who presented earlier, they should send in their fair copy. They share with people and I will upload it in the e-learning, or they can easily upload it to the e-learning direct and then give me a copy on my email, so that I have a basis for giving you marks. I say these are group presentations from the members, and this is where we're getting our first assignment, marks for first test or assignment from. So I hope it is understandable.
Yes, sir. It
Yeah,
is.
it
I
is.
think it
Very
is
clear.
okay.
Thank you. Good night to you all.
All right.
Good night.
Good night to you all.